Welcome back. Today we're talking to Daniel Porter from Pure Asset Management. Daniel is the portfolio manager of the Pure Resources Fund. Pure Resources Fund has an interesting hybrid strategy where it invests in both debt and upside equity. Welcome, Dan.
Thanks, Chris, and hi to all your investors out there.
It's an interesting strategy, but you're not doing it in a traditional equity investment method or style.
We're quite different to a conventional equity fund. Look, we effectively took the old style of a convertible note and decided to break it down into its two core components: straight debt on one side and then equity optionality on the other side. And that's really the genesis of Pure and the way that the company was set up 4 years ago. We run both of our funds like that.
And you're not investing or lending to the BHP or the Rios. You're at the small end of the resources sector.
We focus on that small cap end. So companies with a market cap between sort of 20 mil and 500 mil is our sweet spot. The reason that we do that is we've identified a huge gap in that market. Now, that's really because the larger retail banks, the ANZs, the Commonwealth, have largely all pulled out of financing for the sector. The previous lenders have moved up a scale into that big cap lending territory. And there is a huge gap at the bottom end of the market that we've identified for lending. And particularly our hybrid approach works really well in the resources space because we have companies that are on a growth path. They don't want to excessively dilute, and they have real assets that we can take security over. And that provides our investors with financial peace of mind and ourselves with quality returns that we can pay back to our unit holders.
And the hybrid sector of it, just to explain that, is part debt and part equity upside in the form of options, warrants. Is that correct?
Yeah, that's right, Chris. So when we set up Pure, we took a conventional convertible note and decided that we could invest in a better way. And that better way was breaking it down to its two core components. That is being debt on one side, and straight debt, and then equity options and warrants on the other side. Now, we try to match those against one another. So we have a sort of convertible note type of instrument, but because there's no actual conversion, it does work very, really well in the resources and the industrial space equally. But the benefit for the companies that we're investing in is they have certainty around their equity optionality, and the fact that it is there gives our investors a debt plus type return.
So that gives your investors a steady return. I know you're aiming at 10 to 15% per annum, as well as limited downside. Is that correct?
Yeah, that's right, Chris. So when we invest in companies, we're looking at companies that are on a growth path. So we're really funding catalysts, if you like. So investors get the benefit of the security and stability of debt returns. So we charge our corporates quarterly cash interest. They pay it back to us, and then we distribute that back to our unit holders. So there's a quarterly cash stream coming back to our own investors. At the same time, too, we retain the optionality around the equity. So if that equity does perform, we're able to convert those options and warrants into straight equity as the company grows into it, and return those benefits to our unit holders.
Daniel, just behind you is a nice graphic of an iceberg. Just tell me the symbolism of that.
Yeah, good pickup, Chris. That is something that's there on purpose. So if you think about a conventional equity investor, they're really sitting above the line there. The tip of the iceberg is what they're seeing, so to speak, in terms of their ability to access company information. And because we are a debt fund, we can go over the wall. Everything that we do is with the backing of non-disclosure agreements. So we are holding, effectively inside information on these companies. We can't trade on that, obviously. But what it allows us to do is undertake a lot more due diligence than a conventional equity investor would do. And therefore, we can see what's below the surface as well.
What are you seeing going forward? What types of companies, what types of resources? And also maybe you could explain the limits that you may have.
In the resources space, particularly at that small end, what we are really seeing is access to capital is the biggest issue. A lot of the bigger banks have left the space. There's not a lot of lending going around, and a lot of investors similarly in equity markets not investing in the space for a whole bunch of reasons. So the access to capital is the single biggest issue that we see facing that small cap mining sector. So there is no shortage of demand for what we're doing. What we're investing in, though, is quite targeted. So we're really looking at companies that are going into the production phase in the next 12 to 24 months. So we want to see line of sight to cash flows. The reason we do that is because we hold the debt, obviously, and we want to see those companies with an ability to repay that debt at some stage. We don't look at exploration for that very reason. It's far too risky to take on from a debt perspective. We look for companies with certain parameters in terms of reserves, in terms of mining permits, which is a very big issue today, and the length of time it can take to get a mining permit. And we look for the engineering assessment behind that as well, a feasibility or something of that nature. Now, that gives us two things. One is a very tangible and valuable asset. Whether that company makes it or not, we have security over that asset. We can then sell it to someone else if the investment doesn't go well. But that asset is worth a lot more than what we're investing into that company. So we're comfortable with that asset backing.
So one of the attractions from a day-to-day management point of view is you don't need to be as concerned about the direction of the market.
We have downside protection as a natural hedge in our fund, Chris, and I think that's one of the real appeals for investors. Because we're sitting in there on that debt side, we are getting that consistent return every month. At the moment, there's only about 7% equity exposure in our fund. So it is quite small. So even if equity markets are turbulent over the next few months, the ability to hit that fund in a negative way is very limited. Now, when equity markets turn and commodity prices pick up again, we're positioned really well already to sit there and benefit. But we don't need to be so concerned about the day-to-day movements of markets. And we don't need to be so concerned about huge swings in underlying share prices as well.
It's an interesting strategy. And I think there are more and more of these kind of strategies, hybrid credit, hybrid debt alternatives that are really appealing to investors. Regular income, regular returns without as much volatility and downside movement. Is there anything else you'd like to add?
We are seeing a plethora of opportunities. There's certainly there's no shortage of places for us to place capital. But at the same time, we think we've come up with a much better investment strategy that's protecting our investors at the same time as delivering them far more consistent returns than you'll get in other available products. I would just encourage your investors to our website, where you can see a lot of information about the Resources Fund and about our Industrials Fund, and a little bit of a bio on how we operate as well. There's some good videos and some good content on that website.
Daniel, we'll finish on that excellent plug for your website. Bear in mind also that this fund is available via Olivia for online applications and is also covered by a AFM Factors research report. Daniel, thank you for your time.
Thank you, Chris, and great to chat to everybody today.